Alright, what is up? This is the very first stream of hopefully what is hundreds, maybe thousands to come for the Zang Fund. And pretty much this is a project that hopefully I'll be able to work on for a while. Pretty much I worked as an intern over the summer and have saved up some money to be able to put that towards kind of this investment portfolio. And I also kind of courted my parents, yes, there's a bit of nepotism here, to donate me a bit of money in order to also kind of accumulate more funds within this portfolio. And over the next hopefully 5, 10, 15 years, I plan to grow this portfolio, help my parents save up a lot of money for retirement, and hopefully buy a really nice house for them. And starting out, I think I have around $30,000. So yeah, it's a decent amount of money, and we'll see where this takes me. Right now, just to give you guys some context and to give myself some context, hopefully when I look back at what's going on here, currently a senior at the University of Maryland. I'm studying finance and computer science. So right now, I'm actually going to stay an extra year. So I'm going to stay in 5 years and plan to graduate. Don't know if I want to do my master's yet. Maybe I saw that there's some cool programs at Yale or Columbia that do financial economics or asset management. I feel like those master's programs would be really cool. And if I don't land any of those master's programs, hopefully I can find a job in equity research or working for some asset management company. You know, I tried recruiting for some of these asset management equity research type roles as an intern for the upcoming summer, but got to the final round for a few places. Don't think I was a cultural fit, so that didn't really work out. And that's why I'm hoping that starting this project, I'll be able to do something that is interesting and fun over the summer, and I can kind of look back at these streams when I get older to see whether or not this actually works out. So today, I'm not really going to touch any of the actual money stuff. It's pretty late right now. It's like 8 o'clock. I got a book called Damodaran. I think I spelled it wrong here. I'm not too sure if I'm saying it right, but Aswath Damodaran. He is a really famous professor at the New York University Stern School of Business, and he wrote a really cool book about valuation. I read maybe the first few pages, skimmed around on some of the chapters, and today I kind of want to go through the first chapter after the introduction on estimating discount rates. So I'm pretty new to... Okay, well, I have taken finance classes, so I have some maybe basic understanding of, I'll call it fundamental corporate finance, and a little bit of, I guess, asset pricing knowledge, very basic undergrad level, and some of the stuff I did forget in class. And so I'm currently in winter break right now, so I kind of want to build on some of the foundations that I have and reinforce those foundations on valuation, accounting, and basic economic, macroeconomic concepts, and also understand what the market is like, understand what specific industries are, I guess, currently being priced at, and also looking at companies within these industries and hopefully making some investments and getting to understand what looking long-term, maybe value investing, and I guess you could call it growth investing, how those types of strategies interact with themselves. So yeah, that's a lot, but I guess I'll just get started on reading. This is exciting. I'm excited for what's to come. I really hope that I don't just stop streaming maybe like once or twice and then everything just kind of stops because I get too lazy or maybe something bad happens to me, which hopefully won't, because I am excited about this. As you can see, I am not good at streaming, but maybe I will get better at it. So I have put up here some Anki flashcards And I remember taking some notes, so I think what I might do is go through some of these notes and maybe read 5 to 10 pages today. My goal is to be able to reach part 2 of, I think it's part 2 of the book, maybe part 3, which is relative valuation. I have about 35 days, 40 days of winter break, so I'm trying to get through that, and also some other stuff as well. All right, so I think let's start here. All right, in general, what are the 3 approaches to valuation? Okay, so I think there's the discounted cash flows method, where you're trying to predict the cash flows of a company, forecasting cash flows and forecasting some of the accounting statements, or I guess metrics, accounts, or concepts, whatever they're called or whatever you want to call them, being able to forecast those in, let's say, the next 5 to 10 years. Other way is to maybe look at relative valuation. So what are the other companies or competitors? How are they currently being priced? Maybe looking at different types of multiples or ratios, price to earnings ratio. I think there's also some, maybe from finance class, like free cash flow to enterprise value, or maybe earnings to enterprise value, and being able to compare all these type of ratios with each other. I think there's another one with options. I don't remember what it's called. Maybe it's called contingent claim valuation. Let's see. Yeah, so contingent claim valuation, I don't fully understand what that means, but I think I'm going to put hard for now. Okay, so what is a going concern discounted cash flows valuation? I think this is one of these types of DCF valuations where you're including the assets that you would expect the company to earn over the course of its lifetime. So I think Damodaran made a kind of observation that there's going concern versus, I think, asset-backed valuation, where going concern is incorporating both growth and current assets, and the asset-backed is just looking at the current assets of the company and looking at the cash flows that those assets would generate. This is a type of DCF valuation that incorporates the value of existing assets and growth assets. Intuitively, this can be thought of as valuing a company's existing investments and future investments that the company will make, okay, by estimation, and the profitability / cash flows generated from those investments. Okay, so it's kind of shaky, so I'll also put hard as well. For growth companies, will asset-backed valuation generally achieve higher or lower valuations compared to going concern? So I think for growth companies, I guess at their stage of the, I guess a fancy way to say product life cycle, or the maturity of the company itself, usually working with an asset-backed valuation, like I said before, you're looking at the current assets of the company and building maybe some discounted cash flows model based off of what the company currently has, which for growth companies isn't a lot because you're expecting a lot of growth in the future. So I think in this case, an asset-backed valuation would have a lower valuation for our growth company compared to a going concern. Oh my god, I'm gonna choke on my water. Okay, so how does Damodaran, Damodaran define risk? I think he defines risk as just the deviation from expected value. So expected value is whatever you would expect to happen, maybe let's say on average. But the risk, I guess in terms of finance or economic, is the deviation from expected value. So whether it's downside risk when you're lower than your expected value, or your upside risk, which is when you're higher than expected value, as the likelihood that we receive a return on investment that is different from the return we expect to make. Okay, Here's downside risk return that's less than what expected, and upside risk return is greater than what expected. Okay. Why is cost of equity different for multiple investors in the same company? So I think this has to do with the idea that different investors have different have different levels, I guess, of risk aversion. That's just a fancy way of saying how much they are willing to tolerate the amount of risk that they're taking. And also they have different ideas of what is the required return for taking on a specific amount of risk. And so I think that's why a lot of companies or a lot of investors within the same company, they have different costs of equities because they think the company might do differently compared to what might perform differently compared to what other investors are thinking. So demand different returns for the same degree of risk. As a result, different expected returns. Okay, that's kind of it. Equity valuation, DCF. Okay, so I think equity valuation is maybe somewhat similar to what free cash flow to equity is, and I think this type of DCF model is really looking at the cash flows that are attributable to equity holders of the company. So when you're looking at the equity valuation, you're probably trying to forecast free cash flow to equity, which is just all of the cash flows that a company has generated over time after considering reinvestments into the company and also paying back any debt-related expenses. So that's interest or just paying back principal. I think the free cash flows to equity is just whatever is left over that can either just be put back into the company or paid out as dividends to the equity holders. Okay, so the expected cash flows are called free cash flow equity, and the discount rate. So okay, eventually we do have to discount these cash flows. It's the cost of equity. So okay, I'll put that as a hard. Cost of capital. I think the cost of capital is a measure of how much an investor expects to make on a similar investment with the same amount of risk or whatever risk he thinks is necessary, or whatever risk an investor might think represents the risk on taking this investment. And so let me try to think here. Cost of capital, usually with companies, they have different types of capitalizations, I guess capital structures, both debt and equity, maybe some preferred shares in there. And so cost of capital usually is measured by a weighted average cost of capital, depending on where the weights are the type of financing available or financing used within the company itself. Both debt and equity. Okay. Opportunity cost for company financing money. There's an opportunity cost with both debt and equity. What is firm valuation, enterprise valuation? So I think firm valuation is opposite, or maybe not the opposite, but different from equity valuation, because you're looking at the entire company now, not what is attributable to only the equity holders, but now also what's attributable to the debt holders. And so firm valuation is maybe a more broad valuation in terms of discounted cash flows of the equity portion. Expected cash flows is usually the firm's cash flow, free cash flow, and the discount rate is the cost of capital. What is free cash flow to equity? Okay, so free cash flow to equity, like we said before, is the idea of all of the cash flows that a company has generated that's really attributable to the equity holders of the company. So this is all of the cash that's left over after reinvesting into the business and also paying down any debts or interest. Amount of cash available to stockholders. Okay. What is a basis equation? Expected return of an asset under the CAPM, I think capital asset pricing model. So maybe the basic equation. Okay, so let me think. the capital asset pricing model, what we learned about in class, it comes with a bunch of assumptions, and the main one is that the returns of an asset can be fully explained by the risk-free rate and the correlation or relationship between the asset itself and the market portfolio. The market portfolio usually being some evaluated index, let's say the S&P 500. So I think the basic equation here is that RA, let's call that returns of an asset, is equal to RF, or risk-free rate, plus beta times RM minus RF. So that's the market risk premium. So I think that is your return, or maybe you could call it the expected return. So I guess the expected return of that random variable, which is the returns on the asset, is equal to the expected value of the risk-free rate, which should be a constant. So let's say that's a constant. Maybe not should be, because it is still kind of random depending on the time period, but let's just assume it's constant maybe. And then the expected value of the market risk premium, beta times market risk premium, which I think we can take the beta out and then multiply it. I forgot what mathematical property that is, but I'm pretty sure we can do that. Maybe that's something I can look back on in the future. But so it should just be the expected return on the markets times beta plus risk-free rate. Okay, so average risk asset, something I marked a question on. Maybe I can mark this as a red. So average risk asset. Is that the market portfolio? Question mark. Okay. Yeah, maybe we'll find out when we read. Okay, free cash flow is all of the cash flow that companies generates that's available to both the equity holders and the debt holders. So these cash flows are a measure of all of the cash that's generated after considering reinvestments into the business. Okay, before making any debt payments. What does Damodaran think the perspective we should be looking for is when determining investment risk? Ooh. I think, I forgot what the term is. Some type of investor who, I forgot what the exact name is, but he's something investor where that person is the person who is currently a stockholder or owns shares of, let's say, some company, and is the one that's most likely to trade in the market, the person who is most likely to lock in the next trade in the market and has direct influence over the price of the underlying investment. So I think what we should be looking at, or through the lens of, is an investor who is making a split decision whether or not they should buy or sell this company and has the most direct influence over the price of the company. The marginal investor of the firm. Okay, it's currently invested in the firm. What is the relationship between firm value and equity value? Firm value is all of the value that is available to both the debt and equity holders, while equity value is just all value that's available to the equity holders. Firm. Okay. Equity value is the firm minus debt value. Here's the value. Equity is the value remaining after subtracting the value of the company attributable to debt holders. Okay. What is the adjusted present value approach, DCF? Ooh, this one is tough. I don't fully remember. I think it's... Ooh. It's one of the three types of valuations that Damodaran talks about. I think it's related to the excess cash flows. adjusted present value, and there's something else I'm forgetting. Yeah, this is a while ago, maybe a month ago. So this approach separates the effects of value, the effects on value of debt financing from the values of a business. So the value of a firm and the adjusted present value approach is it's the value of business with 100% equity financing plus present value of expected tax benefits of debt minus the expected bankruptcy costs. I feel like I'm spelling bankruptcy wrong. Okay. Effects of value of debt financing from the value of assets of business. In a more conventional approach, the effects of debt financing are captured in the discount rate, cost of capital. Just to estimate the actual dollar value of benefits and cost of debt. Okay. Cost of equity is I guess it's a measure of the opportunity cost. So how much an investor, or let's say a firm issuing equity, I guess it depends on who. Yeah, I guess the cost of equity is really dependent on the perspective where you're looking at, right? So I think for an investor, it's kind of like this required rate of return that you would expect to earn from investing in a company that has similar risk qualities. Maybe from the person that is issuing equity, it's maybe the required rate of return of some of the projects that the equity is funding. I think in practice, this cost of equity is usually measured through the capital asset pricing model. The portion of the business. Okay. This is interesting. I'm going to put it again. The excess return valuation framework, DCF. So I think this is one of the 3 examples from Damodaran that's related to adjusted present value. But I think this looks at the excess cash flows. But what is considered excess cash flow? Like what's a normal cash flow versus an excess cash flow? I don't think I remember, so. Okay, no, normal cash flows are cash flows that match the required rate of return, cost of equity or cost of capital. And excess cash flows are cash flows that are above or below the required rate of return. So excess return cash flows can be negative. Capital invested in firm today plus present value of excess return cash flows from both existing and future projects. Yeah, I don't think I'm going to be able to remember that. My mind is starting to deteriorate a little bit. It's only been 30 minutes, man. No, not even actually. Probably like 15. Oh, man. Yeah, this is hard. I didn't get much sleep. But that's just an excuse. That's just an excuse. Alright, the market portfolio. So what's the market portfolio used in CAPM? Usually it's just the S&P 500. I think academics think that it's the portfolio that has all of the stocks in the entire world. The best portfolio with the highest utility after is the market portfolio. Okay. According to Damodaran, why do investors stop diversifying? I forgot what Damodaran said might be the reason why investors stop diversifying. I think that maybe one of the reasons why is because the marginal gain from diversification is not that high compared to the loss in returns, I guess. Like, the marginal gain is not that high. trend lower as new stocks, assets, and stocks get added to portfolio. Undervalued stocks and bonds. Okay, so I guess this maybe has to do with one, the marginal gain, so for diversification, but also the fact that activists, or not activists, but active investors believe that they can find undervalued stocks can be bought and held. Okay, maybe. Why does an asset add risk to the market portfolio? Why does an asset add risk to the market portfolio? It sounds like these two statements contradict each other, right? Maybe an asset doesn't add risk to the market portfolio because it already has all of the possible assets, but it does add risk. I have to see what this means. Okay, so that's what I mean. I guess I mean I'm talking about the idiosyncratic risk, firm specific versus market risk. Okay, let's do that again. How can we statistically measure risk added by an asset to the market portfolio? I think maybe we could take a look at the covariance with correlation between the assets and the market portfolio. So I think the variance is equal to variance of A plus variance of B plus the covariance of A and B. Okay, so I need to figure out the mathematical concepts. How do we calculate an asset's beta in the CAPM? An asset's beta can be calculated as the return on an asset minus the risk-free rate divided by the market risk premium. So beta is a measure of exposure market to market risk for an asset. Mathematically, an asset's beta is a standardized version of the asset's covariance with the market portfolio. Okay, this one is pretty hard. I still don't fully understand. The marginal investor is the investor who is most likely to make the next trade, and I think is the most likely investor who, I guess the investor who has the highest influence on the price of the company and is also a stockholder as well. Liquidation value. Liquidation value, I think, is a way of valuing a company and seeing how much value or how much value that company has if it were to sell everything today on its balance sheet. And usually with these liquidation valuations, they're probably going to be lower than the actual carrying value or maybe book value of the assets on the balance sheet, because if we were to liquidate everything today, there might not be enough buyers, and in order to attract buyers, then the company would have to sell some stuff at a discount. Assets with the perception that the business had to sell everything today. So we sold at a discount to attract buyers. a large number of factors, including but not limited to the number of buyers, the economy, and heuristics. I forgot what that is. Yeah, liquidation value. Okay, so we kind of come full circle here to the capital asset pricing model. I think, is there anything? Estimating discount rates. I think this is something I want to take a look at. And then once I finish these, then I'll head to the actual book. Okay, so the basic equation of expected return of an asset under the capital asset pricing model is expected return is equal to the expected risk-free rates plus beta times the risk premium of an average asset or the market portfolio. What does Damodaran think the perspective we should be looking from is when determining investment risk? The marginal investor, who is the investor that is currently a shareholder within the company and is most likely to make the next trade. Okay. Why is cost of equity difficult to estimate? Cost of equity is difficult to estimate because usually within a firm, people have different types of cost of equities or different values for their cost of equity. I think that's a better way to put it. So it's difficult to kind of pinpoint exactly what is the perfect cost of equity because it really depends on your risk aversion or how much you require in return to compensate for risk. What information do we gain about an asset from the following beta? Assume cap n. So beta is equal to 0 is completely uncorrelated from the market. It's equal to 1, it's exactly equal to the market portfolio. If it's less than 1, it's less volatile compared to the market portfolio. If it's greater than 1, then it's going to be more volatile than the market portfolio in terms of returns. Beta is equal to 0, that means it's just the risk-free rate. It's the greatest amount of risk is more volatile than the market portfolio. Okay. Cost of equity is a measure of, well, we had just talked about this too. I think they expect return on the equity portion of a business, which I feel like it probably needs a better definition. I'll put that as good for now. How do we calculate an asset's beta and the cap M? I think it's the covariance of an asset A and the market portfolio B, or another asset B, and then we divide that by the variance of A. So we standardize it, I guess, by the variance of A. Oh, standardize it by the variance of M. Okay. When doesn't an asset add risk to the market portfolio? When it's not correlated to the market portfolio. And I guess that's when the beta is probably equal to 0, or maybe is less than 0. An asset adds risk to the market portfolio when it is highly correlated to the market portfolio. This is that the risk is associated. The company is firm-specific, idiosyncratic, can be diversified away. The asset moves up or down with the market portfolio, then the asset adds risk to the market portfolio, likely for greater deviation from expected return. Greater deviation. Okay. I think it's still kind of shaky with this one, so. Right. How can we statistically measure risk added by an asset to the portfolio? I think we could probably look at the covariance and the variance of the assets, which is maybe beta, which is a standardized version of the covariance. Beta is covariance of asset A and M, and also divide that by the variance of M. Okay. Oh, so beta is a measure of exposure to market risk for an asset A. I guess maybe not market risk, but market returns. Okay. Alright, so I think right now this is a good stopping point in just practicing and reviewing some of the flashcards that I have. So let me sync this. Nice. So I studied quite a bit today in flashcards. Now I kind of want to, it's 9:20, spend a few minutes reading through chapter 2 on estimating discount rates. Okay, so I'm going to so I'll start with the risk-free rates. Want some pen and paper, or maybe just a pencil. Okay, so let's started here. Today is 12/19/20. 23 day 1 stream. Okay, so risk-free rate. Most risk and return models of finance start off with an asset that is defined as risk-free. Use the expected return of an asset as the risk-free rates. Expected returns on risky investments are then measured relative to the risk-free rate of the risk-free. The risk creating expected risk premium that is added on to the risk-free rate. So I think this is something interesting we can add. What is the risk-free rate used in risk return models? The risk, so we'll call this Damodaran on valuation, so we call it chapter 2, estimating discount rates. So I think, yeah, this we should copy and paste. The risk-free rate is the expected value, we'll call this expected return, of a risk-free asset. Okay. We define a risk-free asset as one where the investor knows the expected return was certain. Consequently, for investment to be risk-free. So he's talking about some duration matching strategy, which I don't fully understand. Let's see. the real versus nominal rates. Right. There's that. Whoa. Okay. This is a crazy statement that I don't fully understand. If there are long-term dollar-denominated forward contracts on the currency, you can use interest rate parity in the treasury bond rate or riskless rate in any other base currency to arrive at an estimate of the local borrowing rate. For instance, if the current spot rate is 38.10 Thai baht per US dollar, 10-year forward rate is 61.36 baht per dollar, and the current 10-year US Treasury bond rate is 5%. The 10-year Thai risk-free rate in nominal baht can be estimated as follows. I see. Okay. 61.36 is equal to the current present value of the, I guess, what present value, the spot rate is what, $38. Sorry, the spot rate is the current, I guess, foreign exchange rate that you would get for exchanging US dollars into Thai. The 10-year forward rate is 61. So you would receive 61.36 baht per dollar 10 years in the future, and then what do you divide though? Okay. You can adjust the local government borrowing rates by. Okay, these are all footnotes to consider. So if there are long-term dollar-denominated forward contracts on the currency rate, you can use these interest rate parity. I wonder if there's just ways to look up current forward contracts. I'm gonna try to look on my computer. You could adjust local currency government borrowing rate by the estimated default spread on the bond to arrive. The default spread on the government can be estimated using local currency ratings that are available from many countries. For instance, assume that the Brazilian government bond rate in nominal Brazilian reals, BR, is 12%, and that the local currency rating assigned to the Brazilian government is BBB. It's 2% the riskless. So these guys are also claiming that Damodaran's also claiming that countries have defaults ratings themselves. It's interesting. Okay. So bank or the risk premium. Okay, what was I gonna look up? Oh yeah, country credit ratings, trading economics. Oh, the CIA. So Moody's, Fitch, and Standard & Poor's all have so they all have these ratings for countries. I wonder what's Bolivia, Fitch ratings B, Botswana, United States AAA, Standard & Poor's rates AA plus, Uruguay B minus AA. Okay. So Fitch, Moody's, or Standard & Poor's, yeah, those are the three credit rating agencies. And then also, so let's say Thai currency forward contracts. Let's see, 10-year US forward contract, US. Okay, yeah, I don't fully understand what a swap is actually. They're talking about swaps. Okay, yeah, maybe that's something I can look later, but since I don't have any. Maybe it's on. Maybe Interactive Brokers might have if I sign in. Okay. Yeah, I'll do that later. So that's when the risk free in the local currency is roughly set out. Alright, the challenges associated with estimating the risk-free rate in the local currencies often so daunting in some emerging markets that many analysts choose to value companies in US dollars. Or euros. So I might even create a subsection here. Oh, I think I have a booger. I'll be back. Okay, I'm back. Okay, I'll add another create deck. Call this cost of equity is probably built up of the risk-free rates, the risk-free rates, risk premium, and then beta. So I think this will be risk-free rates. So this one, I'll move to change deck. Move cards. Okay. Okay. So there's a lot of good stuff here. Ooh, 10%. All right, I gotta charge my computer. Yeah, everything is used up on yeah, everything is used up. What should I do? What should I do? I have this little cord or power extension cord, and all of the outlets are being used by that extension cord, so maybe I can see this. Ooh, I think this just barely works. Nice. Okay. Ooh, okay, it's yeah, this could work. Okay. Let's get hydrated and let's get to it. All right. Okay, so what are the two conditions for an investment to be risk-free? So one of them is there can be no default risk. So the risk of not being able to be paid back. And there can be no uncertainty of being paid back. I think when we look at risk-free, we usually think of debts. debt investments or fixed income investments, because those cash flows are predictable. They have a predictable and presets, I guess. There's a word I'll use preset for now. The cash flows are preset. You already know what the cash flows are. And sometimes there's just no cash flow. It's a zero coupon. And so you just get the actual face value of the bond or debts at maturity. And so these are the two conditions for an investment to be risk-free according to Damodaran. Okay. So what is the general implication of an investment being default free of no default risk? This usually means that the investment is issued by a sovereign government. It's just like a national government. But it is important to understand that not all sovereign governments have zero default risk. Usually those in emerging economies do. And so there can be no uncertainty about reinvestment rates, which implies that there are no intermediate cash flows. So what does it mean what does Damodaran mean when he claims that a risk-free investment can have no intermediate cash flows? So this refers to the idea that a risk-free investment that serves as a good proxy this refers to the idea that a risk-free investment should have a expected return that is the true realized return on that asset, meaning that the actual return should always be equal to the expected return on a risk-free asset. Okay. Therefore, a risk-free investment can't have any intermediate cash flows because those cash flows can be reinvested at a future spot at, let's call it the future spot rate unknown today. So it's just whatever interest rate is in the future. So therefore, a risk-free investment can't have any intermediate futures unknown today, which adds ambiguity on the to the expected return on the assets due to random events, interest rates in the future. Okay. Is a so when trying to estimate the risk 5-year risk-free rates, will the following returns be a good representation? So, a risk 60-day treasury bill turn on a 5-year treasury notes, turn on a 5-year 0 coupon semi-annual coupon payments, and then call these no coupon payments. So what? This is not an accurate measure of the risk-free rates because after the 60 days is over, the return on a new 60-day treasury bill is unknown today. This is not an accurate measure of the risk-free rates because the coupons received each semi-annual period can be reinvested at an unknown rate today. This is an accurate measure of the risk-free rate because the investment is default free, backed by U.S. government, and has no intermediate cash flows, pays no coupons, and just turn the principal. That's the principal we want. Could be wrong. Just return at maturity. Okay, I think this is good. So when trying to estimate 5-year risk-free rates, the 5-year risk-free rate, will the following returns be a good representation? So 60-year treasury bill, 5-year treasury note, 5-year treasury note with no coupon payments. So the first two, they both have intermediate cash flows, and the last one does not, so it's probably the best one. Okay. A purist view on risk-free rates will require different risk-free rates for different cash flows in each period and different expected returns. As a practical compromise, however, it is worth noting that the present value effects will behave term structures. Okay, so in practice, in theory, measuring risk-free rates In theory, measuring risk-free rates should measuring risk range from year to year. Changes in the term structure, maybe yield curve, but how does Damodaran suggest even though a purist might say that valuing cash flows at different periods require different risk-free rates. Different expected returns. In practice, the difference between the true risk-free rates and vary year to year is negligible. Let's say that Why is this? Okay, nice. Okay. So, what is the common maturity security issued by governments that is used? What is a common maturity security? For a security. Free security. Used to measure the risk-free rate. Usually the 10-year government bond rate offers a reasonable estimate of the risk-free rates. How does the risk-free rate and what is the relationship between the risk-free rates and currencies? The risk-free rate should be the return on a risk-free asset that is denominated in the same currency that of the cash flows that we are trying to evaluate. Cash flows. Give an example. An example would be using the 10-year Treasury bill to turn on a 10-year Treasury bond, I guess, or I guess note. 10-year Treasury note. I think note is maybe 10 to 20 years. Or 1 to 10 years, and anything beyond 10 years is a bond. I think that's my best guess. Example would be using the return of a 10-year Treasury note to serve as the risk-free rate when valuing cash flows denominated in dollars. Okay. under conditions of high and unstable inflation, valuation is done in real terms. Estimates. How could one estimate the risk-free rate in a currency that's government? How could one estimate the measure the risk-free rate for a currency for investments denominated in a currency that is used by a nation slash sovereign government, sovereign government that is not default free. That has a risk of default. So how could one estimate the risk-free rates for investments denominated in a currency that is used by a nation slash that has a risk of default? So Damodaran thinks that we could look at the largest and safest firms in the market. Marginally. So one could be use the largest and safest firms in the market and use the rate they pay on long-term borrowings and the local currency minus some spread to account for the default risk of the company, of the firm. Safe firm. Okay. Safe in quotations because firms, companies still have risk of default. A long-term denominated dollar denominated for contracts in the currency. Just rate parity and then just rate bond. So what does interest rate parity mean? Yeah, I kind of want to see what interest rate parity means. I'll look that up. Interest rate parity. Interest rate parity is the fundamental equation that governs the relationship between interest rates and currency exchange rates. Okay, I think interest rate parity is just a way of looking at the exchange rate and the interest rates on some deposits so that there's no arbitrage. Okay. I'm gonna say 2 more research on interest rate parity. Okay. 2 more research on interest rates parity. Okay. Estimates the local free rate using interest rate parity from long-term dollar-denominated forward contracts and treasury bond rates. Can you adjust the local currency government bond rate by the estimated default spread on the bond to arrive at a riskless local currency rate? The default spread on the currency rates. Percents. Local currency rate assigned to local governments. Okay. Use currency rating. What is the local currency rating? Foreign currency credit. Local currency rating. Foreign currency credit. Hey.
那你这儿没有那个？
No, unfortunately, 有，但是这儿太多了，我都用完了。
那可以再印从那儿印出来。
Yeah, maybe. This is nice.
那个呢？3个，那个咋俩？
这没有。
没用。
因为 Tony 放上他 laptop。Use the local currency rating. foreign currency credit rating is different from a local currency. May take the form of either an issuer or issuer. Local currency rating. Excuse me. Okay, this ChatGPT is actually pretty helpful. So, how does can a currency have a rating? So what is the credit worthiness of a currency though? What is the mean by the credit worthiness about currency? Do currencies have credit ratings? Hey, Pokey. Okay. Currency rating. Treasury bond rates.
Hello.
What's up? Use the local currency rating. So
I think you'd appreciate this sweater I got.
let me see. Oh yeah, that's fire.
Fire.
Brat's life.
Brats.
Isn't
Wait,
that what
did you grow up around that time? I don't think so.
I don't know.
Huh?
I don't think I did.
Look.
Yeah, I was about to say it looks exactly like your phone.
Yeah.
What size is it? That looks kind of big.
Extra large.
Yeah.
I want it for the gym
Mm-hmm.
to wear over my rompers.
Oh, that's cool. So we could use the local currency rating. So usually measured by
Yeah.
P Global, Fitch, or Moody's. Okay. Use the local currency rating to form an estimate of the default spread.
What else I got for my parties?
Ooh, that's cute. Yeah, that's nice.
Yes, that's.
On government bonds. So I guess that's the goal, right? We need to form an estimate of the default spread on government bonds. What I mean by default spread or default spread is how much risk is included in the return of the government bond to compensate for the possibility of default. Okay, so assuming the Brazilian government bond and all.
Oh, 那个是个 small， 看菜只有到这儿。
Okay.
后面一个干嘛呀？你是躺那不愿意那床上，这个没有地方插那个呀？
没有。
你后边那个都弄满了。
嗯。
哦，你用这个，他用那个了是吧？
I mean, I'll let you use all three, but.
You can unplug it.
Okay, yeah. I mean, I don't need that one right now. It's okay. Yeah. Well,
What's this?
it's because my
You can
computer's.
unplug my thing.
It's okay. Don't worry about it. I don't need it right now.
手上放在真带你睡去了。
Hazardous.
Yeah, there's nowhere for me to plug this in right now.
放这。
So use the local currency. Although I can delete this. Okay.
那真带你睡了，过来。
Take this out for now. Okay, go. ，From estimate of the default spread on losses. Then subtract that the default spread from the expected return on the rates bond to arrive at the risk-free rates return. A risk-free return. Yes, risk-free rates. Okay, nice. Alright, so those are all the notes I have for risk-free rates right now. I'm skipping one on the real growth rates, but I think I might add that another time.
走出去了，走，下去。
这里面是挺深。
那我去给你给弄低一点，行。
是，我把它这样弄一下。
行，走。
快点，
走下楼走去，马上给你去弄那个，走。马上给你去撒点尿去，走。这边去不去？撒尿给你跑回去，走。走就跑回去，走。别，太阳它不下。
There, okay. So we have that. I think now I'm gonna create a deck for the risk premium. Okay. So what is the risk premium supposed to measure? Risk premium supposed to measure. Oh shit. Risk premium in the cap. Asset pricing model. Measures the extra return that would be demanded by investors for shifting their money to an average risk investment. what is a risk premium supposed to measure? The risk premium measures the extra return that would be demanded by investors from moving their money from a risk-free investment to a risky investment. So Damodaran uses this average risk investment. I'm going to put that in these parentheses because I'm not 100% sure what he means by that. The risk premium measures the extra return that we demanded from moving the money to risk-free investment to an average risky investment. Okay. How is the risk premium a function of two variables? The risk premium depends on the following two. Risk aversion of investors, and then the riskiness of the average risk investment. Riskiness of the average risk, I guess. Risky investments. Some other risk. More risk averse, so the required rate of return of the risk premium should increase. Riskiness of the average risk investments. Key though is that the investors perceive to be the since each investor in the market is likely to have a different assessment of acceptable premium, the premium will be weighted average of these minimums. The arbitrage pricing model and the multi-factor models, the risk premium used for individual factors are similar. Weighted averages of the individual investors will demand for each factor separately. So there are three ways of estimating the risk premium in the capital asset pricing model. Large investors can be surveyed about their expectations for the future. The actual premiums earned over a past period can be obtained for historical data. Okay, maybe I should probably understand the capital asset pricing model a little bit. Right, so okay, models measuring market risk. So what was cap? A model is to measure market risk. Okay. What is the APM? Is the R. APM is the arbitrage pricing model. It's used to measure markets non-diverse risk. It's only that assets. The arbitrage pricing model, PM relaxes the assumptions, requires only that assets with the same exposure to market risk trade at the same price. It allows for multiple sources of market risk rather than different exposures beta to each source of estimates a number of sources. So it allows for multiple sources of market risk and for assets to have different exposures betas relative to each source of market risk. Number of sources of market risk exposure and the betas from factor analysis. And a result of the expected return on exposure. Okay, so I think arbitrage pricing model has a lot of these factors. Okay, so this is factor analysis. Okay, so what is the basic idea, I guess, intuition behind the APM? So the APM measures the expected claims that's the expected return on a risky asset can be decomposed into market factors and the exposure of the assets, the risky assets to those market factors. Yeah, I don't really know. Oops. To market factors and the exposure of the risky assets. Oh man, okay. Wait. No. Of the risky assets. Sure, of the risky assets. To those market factors. One. No, I don't have any homework anymore. So we can think of these as betas.
我把那个弄低了。
谢谢。
那你那电够吗？
电够了，够了。
把你这块整理整理，有些要捐的就给我拿出来找出来啊，这你这一架起。
Okay, sure. How does it differ from CAPM? This is different from CAPM because the expected return on a portfolio does not solely depend on a single factor, which we call the return of market's portfolio, but this is different from the CAPM because the expected return on a portfolio does not solely depend on a single factor. It can now depend on multiple factors. Oh shoot. Okay. Specifying the model maybes. Strength bias to weakness. Solution seems simple. Replace the unidentified. What's an What's up?
Wait, are you on video?
Yeah,
Oh.
it's okay. Because you told me to film it, right?
Oh, okay.
Yeah.
This is the filming?
Yeah, that's it.
What program is it?
I think it's called OBS Studio. So this is, I just watched the YouTube video on how to
Very
live stream
cool.
on YouTube.
Tell me what's the best setup, and I'll order that as a present for you.
I don't know.
Okay, we'll watch something.
Yeah. Okay. Fine. Factor.
你要 cheese 吗？
啥我不要，我要睡觉，我不能吃了。我刷刷牙睡觉。学习呢，儿子，啥呀？你们呢？
这在读书呢，不是在。
这是你买的那个啥的，自己买的书读呢哈。
也。
投资的。
就是投资的。
行。挺好，学习吧。
也。
喝点。 思，我给你搜一下吧，明天。
明天
明天没啥事，这个你穿上长了，明天穿一下我看看。嗯。也可这个。
Okay, I think right now I'm probably going to stop the stream. Maybe at 11. I think. So I'm a slow reader, and I was able to get through maybe 5. Let's see. 1, 2, 3, 4, 5. Yeah, around like 5, 6 pages. But made some really good flashcards. I think what I'm gonna do then is say discount rates. Okay, so let's review some of these then. What information do we gain about an asset from the following beta? So assume the capital asset pricing model, which suggests that all of the expected return of an asset can be attributed to the risk-free rate and also the exposure of our asset to the market portfolio, which is the beta. So if we have a beta of 0, that means our asset is a risk-free investment or risk-free asset whose returns are the risk-free rate, or the expected return is the risk-free rate. If the beta is less than 1, that means that the asset itself, its returns are maybe a little bit less riskier than the returns of the market portfolio. Now, with the beta equal to 1, that means the asset itself is the exact same return as the market portfolio. And when with a beta greater than 1, that means it's a little bit more riskier than the market portfolio. This is risk is less correlated. Okay, has the greatest amount of risk, is more volatile than the market portfolio. Okay, so I think less correlation reduces risk and greater correlation increases risk. If we assume that all of the returns can be attributed to the market portfolio. Okay. And so when does an asset add risk to the market portfolio, and when does an asset add risk to the market portfolio? So an asset adds risk to the market portfolio whenever the asset itself. Okay, so it doesn't add risk to the market portfolio when it's completely uncorrelated with the markets, and it adds risk to the market portfolio when it is somewhat correlated or highly correlated with the market. Socratic can be diversified away. Okay, so this is the risk associated with the company's firm-specific inducing can be diversified away. As it moves up or down with the market portfolio, then the asset adds risk to the market portfolio, likely for greater deviation from expected return. Firm-specific risk. Okay. What is the CAPM used for? So Damodaran on valuation. The CAPM is used as a model of the. I guess the CAPM is a model that's used to measure the amounts, to measure non-diversifiable market risk. Okay. what is the APM? So I think the APM is called the arbitrage pricing model, which is really just a fancy way of saying it's another model that's used to measure non-diversifiable risk. What is the basic intuition behind the arbitrage pricing model? How does it differ from the capital asset pricing model? So the basic intuition behind the arbitrage pricing model is that the expected return of an asset can actually be decomposed into different factors, and these could be kind of maybe synthesized, or synthesized is a fancy word, maybe just recognized through patterns of historical data. But going back to what the arbitrage pricing model says is that these returns can be decomposed into these different factors, and then you measure some type of beta or exposure of the current asset to those factors. And this differs from the capital asset pricing model in the sense that in the capital asset pricing model, there's a single factor, which is the return of the market's portfolio, that determines the expected return of an asset. And all of that risk and return is captured in the asset's beta. Okay. What is the risk-free rate used in risk return models? So the risk-free rate is the expected return of a risk-free investment. What are the two conditions for an investment to be risk-free? The issuer or the actual investment must be default-free. So it cannot have any default risk, which means that it cannot have any risk of not being paid back. And also there must not be any intermediate cash flows. And so that relates to the fact that you want your risk-free rate to have an expected value that is going to be 100% equal to its realized value. So that means the actual return on a risk-free asset should theoretically be the exact same as the expected return on that risk-free asset. So in that case, when we have intermediate cash flows on our risk-free investment, it introduces some ambiguity, because what we're doing is we're receiving, let's say, I think this will come up in the next flashcards actually, so let me get there. Okay, so what is the general implication of investment having no default risk? It just means that usually this investment is issued by some type of government, sovereign government, that can pretty much guarantee the repayments of this investment. Not all sovereign governments have zero default risk. Okay, so this is what I was trying to get to earlier. A risk-free investment can have no intermediate cash flows. What he's really trying to say is that when you have these investments that are somewhat risk-free in the sense that they're backed by governments, it's default-free, but they have intermediate cash flows. Okay, so what I mean by that is, let's say, I think going through an example might be a little bit easier. When you have a 5-year risk-free rate, 5-year risk-free rates, we want to kind of estimate the risk-free rate by using, let's say, a 60-day treasury bill. That has, in a sense, an intermediate cash flow, because we would have to, after the 60 days, buy another 60-day treasury bill, earn some return on that, and then keep repeating until 5 years has passed. But every single time our 60-day maturity treasury bill ends up maturing, the forward spot rate, which is just a fancy way of saying the interest rate in the future, may not be the same as today, and so the return could be different from our expected return. And so maybe that has to do with, I think we learned about something called the expectations hypothesis of interest rates, saying that the future spot rate should be exactly equal to the implied future rate from some type of term structure. But pretty much the idea here, I guess I'm rambling at this point. The idea here is that a risk-free investment should just be a zero coupon, buy and hold type of investment where there's no ambiguity due to the reinvestment risk or reinvestment difference in return or interest. Return on a risk-free asset. Therefore, risk-free investment can't have any intermediate cash flows because those cash flows can be raised. Interest rates in the future. Okay. I'm trying to estimate the 5-year interest rate, risk-free rate, with the following return speaker representation. So 1, no. 2, no. 3, yes. This one is default free and also has no intermediate cash flows. This one has ambiguity in the expected return because you can reinvest those coupons at some type of interest rate in the future. And this similar idea, after your treasury bill matures, then you have to repurchase another treasury bill, and that repurchasing will yield probably a different interest rate due to different fluctuations in interest rates and prices. Okay. Yeah, I think I'm gonna pause for now. I'm gonna sync a little bit. 1.3 hours, nice. So I'm probably going to take a shower now. My face is kind of oily. But yeah, very excited. This is the first time I ended up streaming for the Zhang Fund, and I think probably tomorrow I'm going to continue and maybe do a live stream trying to plan out what I kind of want to get done over the winter break. So I think I'm going to try that out and see what happens. But yeah, Brian, if you watch this, let's say 10 years in the future and you get to the end, if you have not continued this, come on, bro, continue this. If you're falling back in life and you're watching this, I think you're smart, you're capable, you're pretty motivated in college and at this point of your life, and I'm sure you can be motivated or at whichever point in life you are at right now. So, message to my future self, and if you're doing pretty well, congrats, future self, and hopefully I'll see you there soon. Alright, bye.